Hello and welcome to another CashBright short video. In this episode, we're talking about bonds. Now, bonds are often spoken about by investors and finance commentators, and unless you are already familiar with bonds, you kind of end up getting lost when you hear people talk about high yield bonds, low yield bonds, interest rates, maturity dates, etc., etc. Well, fear not, because although these terms sound complicated, they really aren't. And once you decode the jargon, you will see bonds are just another way of investing your money. So let's get started by asking, what are bonds? Why do they exist? How are they traded? And how well do bonds tend to perform? A bond is a type of debt security, or debt property. Think of a bond like a loan, where the holder has loaned money to a company or government body in exchange for payments over time. These payment amounts are calculated according to a fixed or variable interest rate. The loan runs for a set period of time, and at the end of the loan period, the borrower pays back all of the money they borrowed. It works just like when you borrow money from a bank, except in this case you are the bank, and companies and government institutions borrow money from you. Bonds exist as a way for companies or government bodies to raise money to finance new projects, maintain ongoing operations, or to refinance existing debts. The details of the bond vary in relation to the amount of interest to be paid, how often payment is to be made, and the overall length of the loan, meaning how long until you get your money back. This end date is called the maturity date. The interest that you earn during the loan period is called the coupon. Like stocks, bonds can be traded in the bond or credit market. Now, it's important to note that this market does not have a fixed, centralized place like you do with stocks, so it's difficult for me and you to participate in this market by ourselves. This is why most people trade in bonds through third-party asset managers. By owning a bond, you will receive a steady, if not relatively low, fixed form of income over a predetermined period of time. This makes bonds attractive for those of us looking to invest our money in retirement plans or college funds. Now, it's important to note that bonds offer a lower rate of return when compared to stocks. This lower rate of return, however, is offset by the relatively lower risk of the investment overall. However, bonds are not risk-free, and the risk associated with a bond depends on what's known as its credit rating. Every bond has a credit rating based on how likely the borrower is to make good on its promise to pay up. Now, this is just like yours and my credit rating, which is assessed by banks whenever we want to take out a personal loan. The credit rating is made by private, independent rating agencies such as Standard & Poor's or Moody's. Bonds are rated by these agencies using letters such as AAA, BBB, or CCC. The higher the grade, for example AAA, the lower the risk for the bond holder, and the higher the bond price. The price for AAA rated bonds are higher because naturally more people would want these kinds of bonds. On the flip side though, the return on AAA bonds will be lower than on the riskier CCC bonds. And this is a common theme in finance. The higher the risk, the greater the reward. But we know things in life have a tendency to go south, and this can of course happen with your bonds. If the borrower runs into problems and doesn't pay you, you can end up losing all of your money. So like with stocks, it's a case of carefully assessing your options and building a trading portfolio which looks to minimize the risks as much as possible. We hope you enjoyed this video and that you now know a little bit more about bonds. For more videos on all things money and finance, don't forget to tap that subscribe button. Until the next time, stay cash bright.